Hi, I'm Robert Maltbie. Welcome to Maltbie's Minute on the Market in August. Wrapping up another summer, August 2021. Feels like a typical August with the long days and the heat and the grind. In fact, speaking of grind, the market has been actually in a grinding attrition since really February peaks, evidenced by the magnitude of the amount of company stocks trading above their moving averages. Back in February, it was 80% above the 20-day moving average, and during this grind, we're down to about 35% above the moving averages by a nice margin. So, value growth, rotation, COVID. Now the bulls have gotten the Delta variant. Once again, this exogenous factor from the virus has exerted a dominant influence on the market, and due to the short-term uncertainty, risk-off trades have become the order of the day, and that's again evidenced by the leadership in the big cap tech and the long-term bonds and the vaccine stocks. A relentless media push and campaign has rekindled the fear of corona in the new Delta variant across continents and markets, ignorant of key long-term trends that have underscored and are showing that we are actually approaching, in many of the G7 nations, herd immunity. Our bet, supported by the data, is that the Delta variant wave is far less lethal than previous spikes and thus will represent an attractive buying opportunity for reopening focused equities. The Delta variant started in India and it spiked, and this was in May, and it's collapsed over 80%. It then moved to the UK, where it also spiked in July, roughly a month ago, and it's collapsed over 60% in the UK, and they've fully reopened their economy when it was at its peak, the Delta variant, in terms of cases. 15% of the, back to India, the Indian population was double vaccinated, very low rate of vaccination. 1% of low-income countries have received double vaccinations, and yet deaths from COVID are down over 50% from the mean daily rate above inception. A lot of stats here, but we're trying to be data-driven and let the science of the data guide our decisions. So, therefore, the Delta variant, where again, back to the cases in the UK and India, there's been no discernible uptick in associated death rates, showing there's a lot more bark than bite. Therefore, we believe that at the end of summer coming up, this trend will be apparent in the US, where the Delta variant is now spiking. So that may be 3, 4, 5 weeks, but we think it's going to lead to a nice re-entry in the reopening trade. Going to our major market indicators, they're bullish. Sentiment is negative. The put-to-call ratio on the S&P is positive at 1.4. Other fear measures, such as VIX and VXN, are declining. The technical indicators are uniformly positive. All moving averages for the market indices are above their 200-day moving average lines. Also, the new high to low indicators generally positive. Advanced decline volume and breadth, though, continues to be neutral. So we're in kind of a mixed market, like I had mentioned, a grind, an attrition, and this underscores the narrow upside of performance lately, evidenced by the narrowness of the big cap tech leadership. Liquidity indicators are mildly positive. Margin rates are high. But the cash to money to the market cap is over 10%. So there's ample support at current market levels. Money market cash exceeded 4.5 trillion. Buybacks over 2.2 billion, led by financials, semiconductors, and electronics. Inflows into mutual funds and equity ETFs exceeded 8 billion. Hedge funds even drew over $1 billion, and IPOs on the other side of the coin resulted in 30 billion more supply. Excluding quantitative easing, injecting 120 billion into the equation, a very dominant factor, the data would have been slightly negative. And that really is the next big issue and bugaboo of the market, is the question of tapering, which looks to be a mixed bag, but it does look to be coming this year, possibly year end rather than next year. So the markets will not like that. They may be adjusting to it now. Back to the indicators, earnings momentum, one of the more positive things, comparing to the downtime a year ago with COVID, everything shut down. As you might expect, earnings are very strong. Surprise ratio 90%, way above the historical mean of 67. Positive revisions, up 3%. Year-end estimates up as well. And the PE to growth rate ratio on the S&P is at a discount to its historical average, which shows that there's relative value in the market. Two valuations, they're mildly positive. Indicators such as market cap to replacement value and market cap to GDP are negative. Valuation levels approach the dot-com era in the year 2000, so on guard for that. But interest rates now are dramatically lower. That's the big difference. And we point to, with the current momentum of earnings and the current low rates, 5,000 on the S&P, possibly within the 12-month period, implying 13% upside. Wrapping up here, monetary indicators are positive. The M2 is growth in the M2 has receded to 11% versus a peak at 25%. This decline does represent significant tapering. Money velocity has also decreased, offsetting the impact of the increased M2 growth. The liquidity indicator, though, is positive, adjusted for the GDP growth. And so the Fed continues, and monetary indicators continue to be positive. A little concerned with the flattening of the yield curve, with the 10-year bond impacted largely by the Delta variant coming in as investors de-risk, but the 10-year rate is showing a more flattening, but still positive slope in the yield curve. I want to move to our director's letter. Our bread and butter at Singular Research is this letter and the performance and the alpha generated by the ideas. And we've had a good year and a good 12 months. The Singular list year to date up 34.8, and over the last 12 months up 98.3 versus the S&P up 32 and the Russell up 48. So wide alpha provided. And that's what Singular aims to do, is find alpha from companies that are misunderstood and mispriced. Month of July, some of the top performers, we had some buyouts kick in, largely in the gaming sector. DraftKings is getting very aggressive. They have a high priced equity. That's a good currency, $2 billion in cash, and it's a major land grab going on now. They purchased a couple companies off our list. Score Media at a 70% premium, and Golden Nugget Online at a 50% premium. And probably more to come. We'll get to that in a minute. Our worst performers were a new initiation, Greenbox, had a tough month, down 25%, and that's a high growth decentralized finance idea looking to disintermediate Visa, MasterCard, So it's up against the big boys there. We're pulling for it. We did initiate a new name called Socket Media, and that did well. It posted a very good quarter, and the stock spurted up and then sold off, but it's still ahead about 7-8%. We think it has more room to go. So regarding our updates, coverage list, that's available. You can sign up for a complimentary trial and get exposure to some alpha and get a feeling for what we have delivered over the past 17 years. Unparalleled performance in alpha. Now let's talk about an idea that I think plays very nicely into this environment, mentioning the land grab in the online sports betting and the online casino. More states are approving this, and also more exotic types of betting are coming to the fore. Net, it results in a lot of growth for players in this sector. I want to talk about a company that we think looks attractive, had a great quarter, and we think it is an acquisition candidate, possibly at a 50% premium. The company is called Rush Street Interactive, ticker symbol RSI, trades in the $13 range. We see fair value in the $20 area, and we think again DraftKings could be a buyer. Rush is trading at a discount to the recent multiples of the buyouts, about a 40% discount to the multiple of those recent buyouts that I mentioned, and it does strategically add a lot to a company like DraftKings. One of the very important areas in this land grab is online casino, which has got higher margins and right now a little bit higher growth rate than the high growth online sports betting. And this company also has a presence with casinos, and they're in a part of the country that fits nicely with DraftKings. DraftKings is pretty much all online, so they need that presence. They need the online casino. They're online and they're sports betting. So this fills in some weakness and provides great crossover selling. So look at Rush Street RSI. Fundamentally, we think it goes higher in 12 months. Our target is of 20. It's trading at 13, and it could be accelerated by a buyout by DraftKings. So a lot of content here in the slow days of summer as we wind them down. Come to our website, singularresearch.com. Click on a complimentary trial and grab your trial. And we've got a great pipeline of new ideas coming out in crypto, in online sports betting, and other sectors that we think are going to perform as we move towards what we think will be a strong fourth quarter and getting in position for a nice balance of growth with that reopening trade. So I'm Robert Maltbie, Maltbie's Minute on the Market, and we're getting ready to end the summer and get back to work. Have a great summer for what's left.